The Minority Market. Episode 76. Learning from Market Crashes Without Panic. Market crashes are the ultimate emotional test. When prices fall rapidly, news turns negative, and fear spreads across every platform. Most people panic. They sell at the worst possible time, abandon long-term plans, and make decisions they later regret. The minority, however, sees crashes differently. They do not see only destruction. They see information, opportunity, and valuable lessons. A crash exposes behavior. It reveals who was over-leveraged, who ignored risk, who followed hype, and who had no plan. When markets rise, mistakes are hidden by profits. When markets fall, truth becomes visible. The minority understands that downturns are not random disasters. They are part of market cycles. The first step to learning from crashes is accepting that volatility is normal. Markets do not move in straight lines. Growth is always followed by corrections. Expansion is always followed by contraction. Beginners believe crashes are abnormal events. Professionals expect them and prepare for them. Panic selling is the most common mistake during crashes. When prices fall sharply, fear activates survival instincts. The brain wants to escape danger immediately. This leads to emotional exits near bottoms. The minority trains themselves to pause. They do not make decisions in emotional states. They review their plan instead of reacting to headlines. Crashes teach the importance of position sizing. Many traders realize too late that they invested more than they could emotionally or financially handle. When losses feel unbearable, it means risk was mismanaged. The minority uses crashes as feedback to adjust risk exposure and improve portfolio balance. Another lesson from crashes is diversification. Concentrating capital into one sector or one idea increases vulnerability. When downturns happen, entire sectors can collapse together. The minority spreads risk intelligently, reducing dependency on any single outcome. Market crashes also reveal the difference between speculation and investing. Speculative assets collapse quickly when fear rises. Strong businesses with solid fundamentals tend to recover faster. The minority learns to evaluate quality instead of chasing hype. Long-term investors learn patience during downturns. Panic sellers lock in losses. Disciplined investors allow time to work in their favor. History repeatedly shows that markets recover over time. Those who remain invested and continue systematic accumulation often benefit the most. Another key lesson is emotional control. Crashes create extreme psychological pressure. Social media becomes negative. Friends and family spread fear. News channels amplify worst-case scenarios. The minority reduces noise. They limit emotional input and focus on data and long-term trends. Crashes also teach humility. Many traders believe they are skilled during bull markets. When downturns arrive, overconfidence disappears. The minority uses this humility to improve strategies, strengthen rules, and eliminate weak habits. Learning from crashes also means reviewing mistakes honestly. Did you chase performance? Did you ignore valuation? Did you overtrade? Did you abandon rules? Honest reflection creates growth. Without reflection, crashes become repeated trauma instead of education. Another powerful lesson is liquidity management. During market stress, having cash provides flexibility. It allows you to survive volatility and take advantage of opportunities. The minority maintains liquidity instead of staying fully invested at all times. Market downturns also reveal emotional attachment. When traders fall in love with stocks, they refuse to accept reality. They hold losing positions without re-evaluating fundamentals. The minority stays objective. They separate emotional attachment from rational assessment. Crashes create opportunity for learning market structure. You can observe how price behaves at support levels, how volume reacts during panic selling, and how institutions accumulate quietly. These observations improve technical awareness and timing skills. The minority understands that fear creates mispricing. When panic dominates, quality assets are often sold irrationally. Disciplined investors prepare watch lists and wait for favorable conditions instead of reacting impulsively. Another important lesson is building mental resilience. Surviving downturns builds emotional strength. Each experience makes you calmer during future volatility. This emotional immunity becomes a powerful long-term advantage. Crashes also highlight the importance of having predefined rules. When emotions rise, rules protect you from self-sabotage. Stop-loss strategies, portfolio allocation limits, and risk controls become anchors during chaos. Many people quit markets after crashes. They associate investing with pain. The minority views crashes as tuition fees, expensive lessons that create long-term wisdom. Those who stay and learn develop stronger foundations. The greatest investors in history did not avoid downturns. They survived them, learned from them, and adapted. Their success came from long-term discipline, not short-term comfort. The key is not avoiding crashes. The key is learning how to respond to them. Reaction creates damage. Preparation creates growth. If you can remain calm when others panic, you gain clarity. If you can think long-term when others think emotionally, you gain advantage. If you can learn instead of fear, you move closer to the minority mindset. Market crashes will always exist. Fear will always return. The only question is whether you will repeat emotional mistakes or transform volatility into wisdom. Those who master this skill stop fearing the market. They start respecting it. And respect is the foundation of long-term survival.